Joining us now to discuss the headlines as part of our new Curb Your Inflation series is Rick Rieder, BlackRock's global CIO of fixed income. Oversees what, Rick, now $2.5 trillion in global fixed income assets. Thank you for joining us.
Thanks, Sarah. Yep, thanks for having me.
So I'm not sure there's anything particularly surprising in Fed Chair Powell's testimony, though the question and answers could be interesting given the market had such a strong reaction to the Fed meeting, even though Powell said don't pay attention to the dots. And we're only talking about tapering. We're not there yet. How do you read it?
So I'd say a couple things. First of all, the comment about what the Fed did on unlocking the financing markets that were gummed up last year and how many jobs that saved, people don't give them enough credit for that. That was a really big deal because the markets, not just the markets, the economy was on edge. So anyway, that was a big deal. Second part, I would say, listen, there is the markets last week. It was surreal what was happening on Thursday and Friday. What the Fed did was the right thing. You have too much liquidity coursing its way through the system. The Fed's right in describing inflation as transitory. We're not in emergency conditions anymore. We don't need 120 billion a month of quantitative easing into the system. We need to pull that back. The front end liquidity is the system's overstuffed with it. So what the Fed's doing and gently pulling back, they're not tightening. I hear it all the time. People say they're tightening. They're not tightening. They're moving away from emergency conditions. The market reaction on Thursday and Friday with rates rallying, when the Fed told you they're going to be snugging policy up, I don't know, that was surreal. I mean, and today we're just reversing what seemed like a very unusual and I think the wrong reaction at the end of last week.
So what do you do from here? You still like higher yields, stronger stocks, value trade? Is that whole thing goes back?
So, by the way, I thought those graphs that Mike showed were really important around the relative. See, think about if you're an investor and you're thinking about what am I trying to do for the next year, you take those relative lines and think about where are those two lines going. The Fed told you, and rates have to move higher. Real rates at 10-year point at -75, -80 basis points of real rates. That's wrong. Rates should be moving higher, and companies are throwing off. I mean, the economy is going to keep growing. We think the economy is going to grow at 8% real GDP. Earnings are going up. Earnings yields are going to be attractive relative to that. Top line revenue for companies going up. You look at the amount of money being spent on CapEx, on R&D, and the consumption ability of the consumer today, given the delevering. Companies are going to do well. Those earnings yield numbers are attractive. The interest rate numbers are unattractive. So you're talking about divergence in those lines, putting more money in equities relative to safe assets at these levels. I mean, buying the 2-year treasury at 25 basis points, what does that do for your portfolio? We're holding more cash because we just as soon sit in cash and be opportunistic when the markets do like they did at the end of last week, which was, like I say, anomalous.
Or surreal, as you said a few times.
Surreal.
It's David. Yeah. It's funny. We haven't talked as much about the possibility of even more government spending. I don't know what the chances are any longer for a big infrastructure bill or how big you even want to call it. But how does that figure into your thinking about both the end towards the second half of this year and early next year if we do get a big number?
So it's the right point, because I think there are two things that are at play today. One, I do think you're going to get more fiscal stimulus. So we talk about numbers that could be $3 trillion over 10 years when you work through what those numbers could be. That's a pretty good catalyst. That infrastructure spend suggests that you're going to get this tailwind of growth that's going to come into the system. And then you take my point about companies, what they're spending on CapEx, R&D, and by the way, they'll be spending on M&A as well. You've got two catalysts that will keep growth durable, plus you've got a consumer that's in good shape. So listen, you've got to underwrite risk when you're investing in today's market, any market. You've got to underwrite risk. The one that I'm pretty comfortable underwriting is you've got some, if we know where we are today, we've got some pretty good tailwinds that could be even more significant in terms of where growth can come from here. So I feel pretty comfortable. I'm willing to underwrite U.S. growth for sure. And quite frankly, global growth is improving, particularly in places like Europe.
Shepard Smith here. Thanks for watching CNBC on YouTube.